What is going on, YouTube? Welcome to Death and Taxes, a channel that is focused on everything finance, from real estate to the stock market to cryptocurrency, even talking about bonds and how to help you manage your money as best you can. In today's video, I'm going to be talking about the S&P 500, which you can see right in front of you, and I'm going to be making a bearish case on the market. And part of the reason I'm making this video is because I've been seeing a lot of disingenuous content in the last couple weeks of people making either overly bullish cases for the market or overly fear-mongering on the other end. So the goal of this channel is to just look at the market objectively, take in as least of a biased perspective as we can, and look at the data, right? What is the data telling us? What have past markets that have had similar conditions to what we're going through right now, what has happened then? And so that is the goal of this channel, to be as objective and data-driven as possible to help you guys manage your own money, decide when you want to enter and leave the market. So let's dive into the video. So I've got the S&P 500 pulled up right here, and it's looking pretty scary looking at this chart, right? And the crazy thing about this chart is it's 1972, 1973. If you would have just looked at this chart, a lot of people might think, hey, that's what the S&P 500 looks like right now, if they didn't look too closely at it, right? So the pattern that we're going through right now is incredibly similar to what played out in this era. And at the same time, we have a lot of very similar macroeconomic conditions. We've got inflation, which is going through the roof. We've got Fed tightening. We've got negative supply shocks, especially in the energy and the oil markets in particular. We've got overseas wars going on that are causing all kinds of problems. It's a very, very similar geopolitical landscape to what was going on then. So I would like to talk about that, and I'd like to talk about just the overall pattern that's going on here. So we zoom out, oh geez, there we go. If we zoom out a little bit here, you can see what's going on, right? So the S&P 500 was going in this macro bull run for at least a few years. It put in an all-time high at the beginning of 1973 before turning around, going into a downtrend, and then we've got two big bounces here, right? One took us all the way back to 109, and then a big drop that was immediately sold off down to 100, and then another big run back up to 111 before the S&P just fell off a cliff. And the economy later went into recession actually around this time. So that's part of why after this it got really, really bad for the S&P 500, ultimately resulting in a nearly 50% drop from top to bottom. So it's a pretty scary thing. And the pattern is very similar to right now. So I'm going to pull up the current SPY chart, and it's striking how similar it is. We've got a bull market going on for a couple years leading into this. And then we got a huge drop, right, down to, we wicked all the way down to the 419 level on SPY. We got a big bounce back up to 457, a big drop that went even further down. We put in a lower low, just like we did here, technically put in a lower low, right? And technically is the best way to be right? Like we literally put in a lower low in both cases. We actually put in a higher high here at 461, same as we did in October of 1973, before just reversing all those gains. Investors sold off the bounce, just as they did here. And we just put in a lower low last week. So I would be watching this chart here. If we lose this critical support level, I know these were just wicks, but technically we already put in a lower low. But if we lose this support level, we're talking about a drop down to, if I had to guess, and again, this is just speculation, but if I had to guess, I would say the 380 or even the 370 range on SPY, somewhere in there. So I would be watching that, watching what happens in the next few weeks, and be ready for that in case it does happen. And another thing that I mentioned at the beginning of this video is how similar the macroeconomic conditions were in 1973 and today, right? So you look at CPI, we just put in a higher high on, we're just continuing to go parabolic, really. There's really no other way to describe it. CPI is going parabolic. It hit 8.5% year-over-year growth in March. It's actually increasing at an accelerating rate still. So the monthly gain in CPI was from February to March was higher than it was for the previous month. So we're still increasing at an increasing rate. And there's really no sign yet of that starting to pull back. And in response to that, the Fed gave us our first 50-point basis hike in 22 years. So that's pretty incredible. They're again talking about doing that in June and July, both of those months, which is an unprecedented level of tightening, at least in the last 20 to 25 years or so. So I would be watching them and what they continue to do. I would also be watching these CPI numbers. And if you look, the interesting thing, times when inflation is going up and the Fed is tightening have historically been very bad for markets. When did those occur, right? We can see on this chart right here, in the late 1970s, going into 1970, inflation almost tripled. And at the same time, the effective federal funds rate also almost tripled. So it went from 4 up to about 9. So a little less than 4 up to a little over 9. So again, that was a huge move that happened there. And we saw that again happen in the era I just talked about in 1973 and 1974. And then it later happened again in 1980 into 1982 at the same time that, there it is, at the same time that the federal funds rate peaked in 1981. So if we look at the historical data, what happened in the market during those times, in 1968 to 1970, was a huge drawdown in the market, 106 down to about 70, a big drawdown in the market at the same time that the Fed was tightening in response to spiking inflation. Again, in 1981 and 1982, there it is, this period right here, same exact thing. We got a big drawdown in the market from about 140 down to about 113 in response to the Fed tightening and peaking inflation. That's in addition to the era I just talked about in the mid-1970s. So there's a lot of data to support the case that when inflation is high and the Fed is tightening, the markets typically don't do well. And they typically go down at least 30-ish% in these cases. So I would be watching what the Fed continues to do. If they continue to tighten and inflation continues to go up, history shows that that typically has not been good for markets. And interestingly, it has led to inflation virtually every single time. 1970, 1974, 1980, 1981. Virtually every time that Fed tightened in response to sky-high inflation, they actually tightened us into a recession. So I'd be very weary of that, especially given our first quarter GDP numbers that turned negative for the first time since the pandemic began. So this is a pretty scary headline. However, there's a few nuances of the way that GDP is calculated that ultimately affected why this number turned out negative. Mostly having to do with the amount of importing that we did and the rate at which businesses built up their inventories in response to all the supply problems that they're having at the end of last year. So consumer spending, which makes up 60 or 70% of our economy, was actually up 2.7%. So I wouldn't really call that a normal negative GDP quarter. However, there are signs of conditions starting to tip a little bit with the labor market cooling, inflation cutting into consumer spending a little bit. You also have manufacturing orders going down. You have consumer sentiment declining since the middle of last year. So I would continue to watch a lot of these macroeconomic indicators to see if we ultimately end up in a recession here. It's anybody's guess as to when that will happen. However, I want to present you with all of the data so that you can make the best decision that you can. and looking at the current trajectory of the S&P 500, until the Fed ultimately pivots, or if inflation starts to decelerate and start to roll over and decline, until one of those two things happen, I think we're ultimately going to continue this downtrend like what happened in the 1970s here. This pattern is very, very similar, which is it's striking to me. But I would just continue to watch those things, and we'll continue to update you here on what's going on with the Fed, what's going on with the macroeconomic indicators, so that you can make the best decision that you can. If you like the content of today's video, please smash that like button, subscribe to the channel. We got a lot more content coming this way. I'm going to cover both perspectives, the bullish case, the bearish case, on a bunch of different asset classes. And I just want to give you a holistic view of to what's going on in the market. So stay tuned for that. Thank you for watching. Really appreciate it.